Good afternoon and welcome to today's class. My name is Jason Sheppard. I'm an IRA specialist here at NewView Trust, and today we're going to discuss a little differently than our normal classes. We're going to talk a little bit about 1031 exchanges, and today we have a special guest, Brad here from Accruit, who is going to discuss a little bit more in depth than what I'm able to do. So that way we can get started and get you the information that you're looking to do. 1031 exchanges and IRA investing kind of go hand in hand. Both are great strategies to kick that capital gains tax and other taxes down the road moving forward. So I'm going to go ahead and get started. As always, NewView does serve as a custodian for alternative investments. We do not provide tax, legal, or investment advice, nor do we sell investments. We custody IRAs, education savings accounts, health savings accounts, as well as 401ks that hold alternative assets that are chosen by the client. And typically, one of the most common questions I get is what is a self-directed retirement plan? Ultimately, a self-directed retirement plan is a plan that all investment decisions are made by the client. It's purely a marketing term, though. All opportunities, all companies like NewView could offer self-directed plans. However, not all of them do. So if you do have any questions, I'll leave my information, as always, at the very end of this slide. At the end of this presentation. However, at this point, we're going to go ahead and bring Brad on from Accruit. We are sister companies, and we'll love to share additional information. How are you doing today, Brad?
I'm great, Jason. How are you?
I'm doing very well. Thanks for asking. Brad, why don't you go ahead and tell us a little bit about Accruit and the world of 1031 exchanges, and let us know what we can learn from there.
Sure. Thank you for the introduction, Jason. Hello, everyone. I'm Brad Duggar. I'm a senior account executive here at Accruit. We are an Inspire financial solution. 1031 exchanges is quite a complex subject, so I will keep it pretty surface level for everyone. When we are a qualified intermediary, so we jump in on the transaction, which I'll tell you a little bit more about as we get into today's presentation. But we stay in our lane. We are not a title company. We are not a real estate company. We are what's known as a qualified intermediary. Again, we just interject on the transaction and help you facilitate by deferring your taxes out from your relinquished property to your replacement property. We do have 5 attorneys on staff at any time, which is more than any other QI in the country. And collectively, they have years and years and years, even decades of experience. So let's dive right in. I'll be going over quite a few things today. First, I want you guys to understand the mechanics of an exchange, and then be able to provide, any kind of brief description of the purpose of utilizing a 1031 exchange. It's always important that if you have very detailed questions that you speak to an attorney or a tax preparer. We are not a tax preparer at all, so it's best that we join in on those conversations whenever we are working with you. We'll go over what the federal requirements are for a seller and also for a buyer, because those roles are the same. It's the same taxpayer. And then we'll talk about other types of exchanges, and I'll go over the evolution of real property exchanges themselves. And last, we'll gain an understanding of of other 1031 exchange considerations, which is the 2018 Tax Cuts and Jobs Act, and the impact that they had on 1031 exchanges. So first, let's go ahead and take a look at this. This is often an incomprehensible, often ignored paragraph in most state contracts. But for today, I encourage you to go ahead and look at your purchase and sale agreements for your specific state. If they do not have anything in there as a contract standard, I would request more information from your broker on how they would like to treat that information, that disclosure that goes into the contract. So what exactly is a 1031 exchange? Well, the Internal Revenue Code defines it as no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for property of like kind, which is then to be held either for productive use in a trade or business or for investment. Well, that's a lot of words on the screen, but we just want to pay particular attention to a few keywords. Real property held for productive use in a trade or business or for investment, and the term like kind. And yes, we do call it a 1031 exchange after the Internal Revenue Code section number. So typically, whenever someone sells a business or an investment property, and there is going to be any type of gain or profit, the seller will then pay a capital gains tax in the year of the sale. Now, a 1031 exchange allows the seller to defer the payment of capital gains tax. So the basis of the relinquished property then becomes the basis of the replacement property in a 1031 exchange with just a few adjustments in the middle. The cumulative effect for the final depreciable basis, and what I mean is what will be taxed once the last property in the chain of exchanges is sold outright, that is going to be generally lower than if each of these transactions, a sale and a purchase, were conducted without the use of a 1031 exchange provision. And when I mention capital gains tax, there's 4 different levels of taxation. And before I get into that, I just want to make a very important note here that a 1031 exchange is tax deferral. It's not tax abatement. So there's 4 different levels of taxation that the property owner can potentially defer utilizing a 1031 exchange. So first, you have your federal capital gain tax that is going to be anywhere between 15 and 20%. You have tax on depreciation recapture that is 25%. It's a big number there. 25% of the total depreciation taken during the ownership of that investment property. Then you have state income taxes, which range from 0 all the way up to 13.3% if it's applicable in your state. And then you also have the net investment income tax, which is a Medicare surtax that was put in during the Obama administration to offset the cost of the tax burden for the Affordable Care Act. Now, that net investment income tax, there's 2 different levels to that. It's 3.8%. So if it's net investment income over $250,000 for married couples, or if it's a single person, it'll be up to $200,000. Now, there's no limit to how many times or how frequently an investor can do a 1031 exchange, provided that each exchange meets all of the requirements. So they'll defer capital gain tax and the various other taxes until they cash out on the last property sale. Once the final replacement property is then sold, fast forward all the way to the end. Once that final replacement property is sold, the original deferred gain plus any additional gains realized from the purchases of the replacement properties is then going to be subject to tax. Again, that is going to be generally lower than if each of these transactions were conducted without a 1031 exchange provision. So you just keep deferring and deferring and deferring. So let me give you an example of how this kind of works. And we'll start from the very beginning until the very end, right? 1031 exchange, it offers some very powerful protections. So let's just say that the customer is a 30-year-old married man. He bought his first starter home for cash about 10 years ago, and he then converted it into an investment property 5 years ago when he married. He's now looking to sell that property and reinvest the proceeds elsewhere. So based on his original purchase price of $215,000, and I'm in the sale example here, the current sales price of $300,000 and his long-term capital gains tax rate of approximately 15%, he can expect to pay approximately $9,600 in capital gains taxes. So he'll have approximately $269,400 net cash for reinvestment. That's a typical sale. But if he instead utilized a 1031 exchange provision, his reinvestment cash will be $279,000. And you can see that under exchange 1 example. So if we assume an average appreciation of about 3.4% annually, we'll go off of just a Case-Shiller index. We take that 3.4% annually over the course of 20 years. That $9,600 difference in cash invested results in about a $20,000 higher return. So in other words, with everything else being equal, instead of his first replacement property being worth $545,000 with a $279,000 investment, it would be worth around $525,000 on a $269,400 investment. And the increased ROI continues with each deferment of capital gains until he chooses to cash out. He doesn't want to deal with management anymore. He really just wants to retire and maybe travel the world with his wife. Well, now let's assume he waits until he's in his 70s to go ahead and cash out. He and his wife, they're retired now. Their joint income puts them into a 0% tax bracket for long-term capital gains. You can kind of see where I'm going here. Obviously, we can't predict what tax law changes may happen in the next 40 years, but based on today's rates and this pretty simple example on the screen, he and his wife would net the full $920,700 with zero capital gains taxes owed. Now, do keep in mind that this is a pretty simple example, and these tax law changes happen usually with, between administrations, or, if anything does happen with the IRS, they like to, make some changes. So keep that in mind as we're going through. A question that I receive often is, Brad, when do I pay my deferred taxes? Well, you can eventually move into one of your investment properties and claim that as a primary residence, right? That's an option. Or how about capital gains taxes eliminated altogether by leaving property to your heirs? And what's pretty interesting about that is whenever they receive that property as an heir, they get it at a basis. They inherit it as a stepped-up basis. So the market value, the day that property is inherited, that is the new basis going forward. So if they sell that day, or maybe the next day, or maybe the next month, and there is no gain, there is no capital gain tax. So these are two of the most common questions that we get whenever, hey, when do I actually pay them? Now, on the screen right now is some motivation words for a 1031 exchange. Think of these as like, green flags, right? Whenever you are having conversations with maybe your financial advisor, or maybe you're calling in and speaking to NewView Trust, whenever you're having these discussions, if any of these words pop up, it should be a green flag that, hey, maybe I should, kind of check into a 1031 exchange and see if it's going to work out or not. Based on what your intent is going forward in the future. So now that I've got all that out of the way, let's take a look at a step-by-step look at a typical 1031 exchange. This is an overview of the process. So early on in the process, you'll select the qualified intermediary, and you'll go ahead and list the property, list the relinquished property that you're going to sell, right? And it's very important that you speak to the qualified intermediary, one of us, in order to see if the property is going to qualify, and then your replacement property, is that going to qualify based on intent. So once you list the property, that is when, or once you get a contract on the property, that's whenever we will go ahead and jump in, and we will work that out with the title company or the closing attorney in order to facilitate the exchange and have constructive receipt of those funds. You notice that the sale proceeds will go to the qualified intermediary that's held in a separate account. You'll have 45 days to identify, and then after that, the balance of that 45 days or the entire exchange period will be 135 days left. So you have a total of 180 days. The first 45 is the identification. And then once you close on that replacement property, your exchange will then be closed and complete and ready to go. And we'll see you next time for it. So the 1031 exchange itself follows the taxpayer's Social Security number or their EIN. We call this the same taxpayer rule, which I'll go into detail in a few slides. But the key point for now is that the qualified taxpayer is the person, partnership, corporation, LLC, or trust that is performing the exchange. We refer to them as the exchanger. The timeline. I always find it easier when things are displayed in front of me as a graphic. So if you're one of those picture people, I am too. This is the entire exchange period that I just mentioned in the last slide. You can see that day 0 is the closing day. That's day 0 in the exchange. You have 45 days to identify, and then you have 135 days left to close. Now, whenever we talk about the identification, right, the first 45 days of that, the property does have to be identified unambiguously in writing and held or sent over to the qualified intermediary so that we can hold on to that and keep record of that to show, in the unfortunate event of an audit, if that does happen, that we can show that you took the appropriate steps to facilitate your exchange. It's very important to note that while you're going through here, and I'm going to put a little bit of emphasis on it because this does happen quite often, but people seem to think that after they close on their property that they can set up an exchange. Well, no, we need to do that prior to closing so that our exchange agreement is signed prior to closing. We don't like to, and we can't hold up closing. So it's important that in the very beginning of the process that we go ahead and work with you to make sure that we're taking the appropriate steps. But always contact us in the very beginning so that we're able to facilitate that for you. Often I get this question too, when you're choosing a qualified intermediary, what is it that the QI does? Well, we are an independent third party, like I mentioned, qualified intermediary. We go ahead and hold on to the funds. So we take constructive receipt of the proceeds from the transaction and we hold those for you. Now, we can't have a family relationship with you, so that cuts that out. And then we can't have a business relationship with you in the preceding 2 years. So it's important to note that the qualified intermediary is that independent third party that is not facilitating any other part of the transaction. Well, we won't need to do anything until the relinquished property does go under contract. It's a good idea for the taxpayer or you to consult your financial or tax advisor and identify that QI early on in the process. Again, before listing the property, just to be certain that it's going to qualify for 1031 exchange treatment. Also, you'll benefit from our guidance. We take pride in making sure that all the steps are taken and there's nothing that could go wrong with the exchange. Now, another question that I get quite often is there any information that needs to go into the listing agreement with your broker, any kind of disclosure language? It's not required by the Internal Revenue Code in a Section 1031, but disclosure is always best practice, typically a good practice to use. So once you have a purchase offer on the property that is to be relinquished, again, let us know that you have that because we will need that along with a title commitment in order to start your exchange. Here we go. Now we've fast forwarded from listing the property, you received a contract or an offer on that property, and then now you are going to closing. So closing day is day 0. The QI will then instruct the title company to deed the property directly from the taxpayer to the new buyer or purchaser, but the net sales proceeds must go to the QI's account without ever touching the hands of the taxpayer, okay? So it's quite common too, we get the question of, well, if I sell in Florida, can I buy in California? Or if I sell in California, can I, buy in New York? Absolutely. There's no boundaries whenever you're utilizing a 1031 exchange. So most people, whenever they are moving to another state, may, typically want to take their properties with them so that they can keep an eye on them. So just remember that a missed deadline in any of this means no tax deferred exchange. Okay, we'd love to offer out little extensions here and there, but we can't. That is the Internal Revenue Code, and it's same rules apply to everybody. So when we talked about identification, the Internal Revenue Code requires that the replacement property be identified within 45 days of the closing of the relinquished property. Now, those 45 days commence the day after closing. Remember, we said closing day is day 0. These are calendar days as well. So if your deadline, the 45th or the 45-day or the 180-day hard deadlines, fall on a Saturday, Sunday, national legal holiday, or even an observance of that holiday, that day still remains the deadline for that identification or exchange period deadlines. After the 45 days, a new property may not be introduced. So again, no extensions are going to be allowed under any kind of circumstances unless there is a federally declared disaster. But it's always best that you speak with your CPA to see if there's any kind of granted extension in that area where there may be a natural declared disaster area.
Hey, Brad, while we're talking about that, a question did just come in basically asking, what if they don't identify a property in that 45-day window?
If they don't, then unfortunately, we can't extend that out. And that's an excellent question. We do get that quite often. If you don't identify anything by day 45, day 46, that becomes a failed exchange. So then we're going to be wiring those funds directly over to you because we can no longer facilitate the exchange. It's ineffective at this point.
Perfect. And one of the other ones that came up earlier as they came in, what if the property, you do everything under that 45-day window, but day 47, it falls out of contract for whatever reason, inspection, whatever. What happens then?
So that's an excellent question too, Jason. Typically, what happens, and it sometimes happens this way as well, but once you go past those 45 days, no new properties can be identified, right? So, and no fault of your own, if something fell out of contract after that 45th day, with nothing else, identified there, that exchange has now failed. But since the taxpayer did go ahead and identify, the Internal Revenue Code says, well, they're not entitled to receive their proceeds from their transaction until day 181, which is the end of the exchange period. So it's important to make sure that the property or properties that you are going to be purchasing within that 45-day window, try your best to make sure that this property or that property is going to carry through. I'll stress the importance of looking at a title commitment whenever it comes to purchasing a property. Most people have no idea what a title commitment is. It's a proposed insurance policy for the actual property. But what ends up happening is sometimes there's you would see something on there on the Schedule B1, which is like a checklist in order to issue clear title for that property. But if you check within that checklist there, it'll say if anything needs to happen when it comes to like probate, which has become a topic recently because of so many probate cases coming up with new files for title closing. So again, it's really important to make sure that by the end of that 45th day, you're solid on what it is that you want going forward. And we'll be reminding you throughout the process. We do like to keep tabs on everything and make sure that we don't want a failed exchange. We want to make sure that you're able to facilitate that exchange and you're happy with everything going forward. Do we have any additional questions, Jason?
Nothing else has come across, so we'll move on forward from
Awesome.
here. Absolutely.
Thank you, sir.
I'll let you know if anything else pops up.
Awesome. Sounds good. Okay, so we talked about the 45th day, and while we're still talking about the 45-day identification window, let's go ahead and talk about the 3 rules. And there's 3 different ways to identify potential replacement properties. And the first one is the 3-property rule. This one just states that the taxpayer can identify up to 3 potential replacement properties within that 45-day identification period without regard to the total fair market value of those properties. Now, and you only have to hit one of these rules, okay? The second rule is the 200% rule. So basically says that the taxpayer can identify an unlimited number of properties as possible purchases, as long as the total fair market value of all the identified properties is less than double the value of the relinquished property. So going over 200% with 4 or more properties could result in the IRS disallowing the exchange altogether. Now, if you didn't hit the first rule, you didn't hit the second rule, typically you're going to hit the third rule, and that's the 95% rule. So it's another alternative is you may identify alternative properties as long as you receive at least 95% of the value of all identified replacement properties before the end of the exchange period. Okay. Now, still on identification, the QI accepts the list of potential replacement properties on behalf of the IRS, and we must document the date that list was received. So that's why after 45 days, you can't identify anything else. What's interesting, though, is this list is not required to be filed with the IRS, but we do keep those records for a minimum of 7 years. Well, before I mentioned in the very beginning, I mentioned the term like kind, and this is a question that we get very often. I feel like it's almost on every discussion that we have with a new client or customer. Like kind itself refers to the use of the properties. Remember, we said it must be held for investment or utilized in a trade or business. Well, investment property, that term is very broadly defined. But I'll just say if you're utilizing an investment property and you're reporting this as an investment property, or even if it's vacant land, right? Vacant land will always qualify for exchange treatment. But let's just say that a commercial strip center, if you want to go from owning commercial property, then you want to go ahead and purchase rental properties. Absolutely, both are held for investment. What about if you have a vacant lot and you want to purchase an office building? Absolutely, because both are utilized as investment. So quite often I'll get the question about a second home. Unfortunately, because of the taxpayer's personal use of the property, it disqualifies for exchange treatment. But whenever we do have that conversation with you, we like to go ahead and structure that out so that you know the rules going forward, so that way you in the future will be able to take advantage of a 1031 exchange. The reinvestment requirement. This is, again, a very common question. So in order for the taxpayer to defer 100% of the tax that was on the gain of the sale of the relinquished property, the taxpayer must trade up or reinvest 100% of the net equity into the replacement property. And that replacement property must be of equal or greater debt than the relinquished property. Or maybe you don't want to take on any more debt as a loan, like an institutional loan. You can certainly take out cash and you can insert that into the transaction to minimize or eliminate that debt requirement. But if you think about it, if you have $1 million property and you have $500,000 loan on it, whenever you close on that property, that loan will be paid off. You have $500,000 left over, but we have to do equal or greater value from what you sold. So now we have to do at least $1 million to get that 100% deferral. So either you can insert $500,000 in cash, you can ask the seller of the replacement property for maybe a seller-backed loan on that property, or seller financing, or you can go ahead and get an institutional loan from a lender to go ahead and put that in there, replace that debt. But I found this term pretty interesting because we usually hear it as equal or greater value, and we simply assume equal or greater price. Just remember that the reinvestment requirement includes equal or greater debt, and that should give you a clearer picture of the reinvestment requirement itself. Primary residences. Primary residences can never be utilized in an exchange. They have their own tax advantage. Whenever you're selling a primary residence, you would then use what's called a Section 121 exclusion. I won't go into that too much, but ask your tax preparer about that, because you do get $250,000 to $500,000 off of that no tax will be due on. Now, what's important to know is the taxpayer's intent at the time that they acquired the replacement property. Did they honestly acquire it for investment purposes? Did they maybe have a significant change in circumstances that after the exchange was closed, that maybe caused them to move into that property? All different scenarios come up. Can you prove intention and maybe a change in circumstances? Well, the IRS issued what's called safe harbor rules, okay? And these rules just basically state that the replacement property must be held for at least 24 months immediately following the exchange. So that is what we call the qualifying period. And within those, 2 12-month periods, a total of 24 months, in that qualifying period, the taxpayer must rent the replacement property to another person at a fair rental rate of at least 14 days or more. And the taxpayer's personal use, that's where we're getting into that personal use again, the taxpayer's personal use of the replacement property must not exceed the greater of 14 days or 10% of the number of days during each 12-month period that the dwelling unit is rented at fair rental rate. Now, going from primary residences, sometimes we get questions about the related party rule. And this rule was issued by the IRS to help prevent investors from abusing the 1031 exchange by shifting tax cost basis between parties owned by related parties or properties that are owned by related parties to avoid capital gain taxes. Keyword avoid. So this term related party means any person or party that includes corporations, partnerships, and trusts that has a relationship with the taxpayer that's described in Section 267B or Section 707B1 of the Internal Revenue Code. If you don't want to sift through the Internal Revenue Code, just give us a call and we'll be happy to explain that. But the key point for here is that the replacement property can be rented to a family member so long as market rent is paid. Now, what if the taxpayer wants to sell their relinquished property to a related party? They can go ahead and do that, but both the taxpayer and the related party must hold their respective exchange properties for a minimum of 2 years. Now, that's where the taxpayer or the exchanger is selling a property to a related party. What about if they're purchasing one from a related party? What's interesting about that is the taxpayer may only purchase the replacement property from a related party if the related party also qualifies and completes a 1031 exchange with their sales proceeds. So pretty interesting that they have to do it on both sides if they are purchasing from a related party. Okay, so far we have sold and we've closed on the relinquished property. Now the QI, the qualified intermediary, is holding the proceeds from that sale. We've identified the potential replacement properties within our 45 days. Perfect. Section 1031 requires that the purchase and closing of the replacement properties occur on or before the 180th day after closing on the relinquished property. Now, depending on what state you're in, some states close in escrow, others close immediately. But closed means that title is required to pass to the taxpayer on or before the 180th day. So no closing in escrow. Now, if the property does close in escrow, and you know that 7 days to cure or whatnot during that escrow period goes over the 180th day, this could potentially sidetrack your entire exchange, and it would possibly be disallowed by the Internal Revenue Service because it didn't happen within day 180. So it's important to know that if you do close in an escrow state, to make sure that it does go out of escrow before day 180. Now, the 45-day identification period and the 180-day purchase period run concurrently, right? Which means that after 45 days are passed, there's 135 days left. There's no extensions due to title defects or for any other reason besides the one where I spoke about a federally declared disaster. The replacement property that you do purchase does have to be one that was listed on that 45-day identification list. That's very important. That identification period is super important. It doesn't seem like a whole lot of time, but just, and it's easy. It's a month and a half, basically. So whenever somebody is typically selling a property, they're already looking for a replacement. And that's a conversation that we typically have with our exchangers.
Hey, Brad, right there, a question did just come in. Does that 180, is it like the 45? It includes holidays and everything too?
Absolutely, yeah. The entire exchange period itself, great question. They are all calendar days. So it's not like business days where it falls to the next business day. It is where calendar days. So even if there is like a holiday or a Saturday, Sunday, that still is the date.
Gotcha.
And great question.
Yeah.
Okay, so I mentioned before the same taxpayer rule. This is a very important rule because this is how we actually structure out your exchange. Very, very important. So Section 1031 requires that the taxpayer listed on the relinquished property be the same taxpayer that's listed on the replacement property. So if you are going from a single person over to a single person, totally fine. Now, if you are, married couple here, you want to be married couple there too. Some people want to create maybe a corporation because they want to, or an LLC. LLCs are very popular when it comes to property. People will typically say, I want to go ahead and go from husband and wife here over to, an LLC here. And, we do have that discussion with them. But if it's a multi-member LLC that requires an EIN versus you selling over here using a social. So it does follow the taxpayer social security number or EIN. So however that is listed on the relinquished must be listed on the replacement to complete the exchange. We talked about the appropriate disclosure language whenever you are listing the property. Now this is the same on the replacement property contract. So we want to make sure that you're giving that proper disclosure language. As with the sale of the relinquished property, the qualified intermediary, when you're making the purchase, will prepare the necessary paperwork for the title company or the closing attorney. And again, we effectively take on the role of the now buyer or taxpayer. We're sending the cash equity from the sale of for the sale of the replacement property, for the sale of the relinquished property to the closing for the replacement property transaction. Now, the exchange is now complete, right? So we've gone and we've sold the relinquished property. Now we've acquired the replacement property and the exchange is complete and we are all done. We issue, at the end of your exchange, we issue what's called an IRS Form 8824, and you will file that on your tax return for the year of that sale. So if you sold it this year, January through April of next year, you will be filing your taxes for the previous year. Then you will be putting that 8824 for the tax return either for that entity or you as an individual. And I appreciate you guys sticking with me this far through. We just have a few additional concepts and we will wrap it up and see if we have any more questions.
Absolutely.
All right. We use the term boot quite often whenever we're talking about exchanges, right? But the term boot really just means the type of tax, right? So remember we said that the taxpayer had to reinvest 100% of the net equity into the replacement property. And the replacement property must be of equal or greater debt than the relinquished property in order for us to defer 100% of the tax on the gain of the sale of the relinquished property. Now, what happens if the taxpayer does not reinvest 100% of the net equity and 100% of the debt? Well, got three different boot options here. The first one is the cash boot. Now, some taxpayers elect to take cash out as part of the exchange. However, any cash received will be taxed accordingly. It's going to be either as ordinary income if the relinquished property was held for less than 1 year, or it could be as capital gains tax if it was held for more than 1 year. Now, if you don't replace that debt, that is where we will talk about the mortgage boot. That's our next one. This is when the taxpayer's debt on the replacement property is less than the debt that was on the relinquished property. Like I said before, additional cash from the taxpayer can be added to offset that mortgage boot. And the last one is non-like-kind property boot. And this is, any non-like-kind property that is received by the taxpayer from the exchange does not require or does not qualify for tax deferral treatment. And it is also considered taxable boot. Now, the term boot won't be found anywhere in the Internal Revenue Code or regulations. Again, it's just a loosely used term that we use as qualified intermediaries. Okay, so reverse exchanges. These are becoming very popular, and we talked about selling the relinquished property and then purchasing a replacement property. But what about if we did that in reverse, right? There are options. These are reverse exchanges. Any type of exchange like this, we call them parking exchanges. But there's an important thing here when it comes to parking exchanges, because title to both properties in an exchange cannot be in the same name at the same time. So remember, you're holding this relinquished property in your name, and you want to go ahead and purchase the replacement property before you close on that relinquished property. Well, both names can't be in the same name, or both properties can't be in the same name at the same time. Creates a little bit of an issue, but we have a solution for it. Let me go over a few reasons, possible reasons for reverse exchange on why somebody would choose to do this. Let's just say maybe they find the property that they wish to acquire before they've sold the property that is going to be relinquished. Or maybe the sale of the relinquished property fell through, right? Happens, it's real estate. And the taxpayer doesn't want to lose out on that replacement property that they're under contract for. Maybe in a hot buyer market, the taxpayer may want to buy first to eliminate the pressure of having to identify and secure the replacement property within that 45 calendar day identification period. Or maybe improvements need to be made on the replacement property, right? These are all quite common reasons to utilize a reverse exchange. Now, when we go into a reverse exchange, there's quite a few parts that go into it. So I'll just give a general overview. So first, what happens is the taxpayer enters into what's called a QEAA, or a Qualified Exchange Accommodation Arrangement, and they do that with the qualified intermediary. Now, we go ahead and create what's called an EAT, or an Exchange Accommodator Title Holder, and we create that in order to take title or park either the property that is going to be relinquished or the property that is going to be acquired, but not both, okay? The EAT is usually a limited liability company that is created solely for the transaction. So the property to be relinquished must be sold and closed within 180 days of first acquiring title to that replacement property. So once the relinquished property transaction is closed, within 5 days, there's two things here. Number one, if the replacement property was parked, the EAT will then deed the property title to the taxpayer. Or number two, if the relinquished property was parked, proceeds from the sale go to the EAT, which then directly reimburses the taxpayer or wires funds to the replacement property lender to pay down that new note that was taken. It's typically easier whenever it is a cash transaction, but some people utilize a loan. So we do have options for all of that. Now, what about if you want to use your exchange proceeds to make improvements on the property, the new property that you wish to purchase? You can do this in reverse and forward. Remember, both properties can't be in the same name at the same time, right? So possible reasons here to utilize a improvement exchange. Well, the taxpayer finds a vacant lot or maybe a less than value, so a value add property in a preferred location that they want. Or maybe the taxpayer purchases a property, but they have a surplus of excess or leftover funds in their exchange account, and they've got the time to go ahead and make those improvements. Sometimes easier and more economical to purchase a property and improve on it. Again, it's all in what your intent is and which way you'd like to move forward with it. But the QI, again, must use an EAT to park the property that is being purchased, and the taxpayer must identify the property that is to be relinquished within 45 days, along with the intended improvements and the costs that are associated with that. So the taxpayer also is entitled to be the contractor for the improvements. If they so desire, they can elect a contractor to handle those types of invoicing and everything, but the taxpayer must approve that invoicing before we send out any type of exchange funds to pay for that invoice. Now, that was an improvement exchange. There was a couple of things. I promised you in the beginning that I would talk about the effects of the 2018 Tax Cuts and Jobs Act, which was tax reform on 1031 exchanges. So there was a major change, and there's a possible problem that goes with it. But the major change was it repeals the use of Section 1031 for personal property, such as artwork, auto fleets, heavy equipment, so on and so forth. Personal property that is part of the investment property is no longer eligible for tax deferral, right? So just keep that in mind whenever you are purchasing or selling property where you're going to include personal property. And on that, just keep in mind that you cannot use your exchange funds for personal property. It has to be for the real estate itself. Now, the possible problem it is ancillary personal property will likely constitute taxable boot in your 1031 exchange. But again, let's talk about that, and let's structure out your exchange and figure out the best way going forward, on your exchange, and how to get the biggest bang for your buck out of your exchange and defer those taxes by 100%. We have actually reached the end here. So I want to ask Jason if there's any kind of questions or anything while I leave our contact info up on the screen.
Absolutely. No, we'll leave that up on the screen. No other additional questions came in, correct? Correct. Perfect. So we'll leave that up on the screen for a little bit. Also, if you do have any other questions, we are happy to share that information over with Brad if you do call into our team from there. So really do appreciate you taking the time today, Brad. Gave us a lot of great information. A lot of questions from our clients come in about those, especially when we're out at these real estate events. A lot of people just assume that we can assist with the 1031. So it's great to have this content and also a contact. So if we do come across anybody here locally that can utilize your services, we'll pass that information along.
Appreciate that, Jason.
Absolutely. Absolutely. So if you'd like to speak with NewView, or like I said, if you'd like to get back in contact with us, you can scan this QR code right here and we can chat, see if IRA or 1031 best fits the type of investments you're planning on making. We'll get you taken care of and we'll go from there. Please, as always, do stay up to date with NewView. We have all of our socials right there. You can use that QR code to utilize that. You can call us anytime or visit our website. And if you have any additional questions for Brad, we can get you in touch from there. So we do appreciate you taking the time today. If there are any additional questions, we'll pause right there for a second. Perfect. Well, we do appreciate you taking the time today, learning. Thanks again, Brad, and all of the Accruit team for all the great work they do. And we're happy to help out if any questions pop up in the future. Hope you guys